Canadians are playing a game of Monopoly in which some have one property that is mortgaged, other players own no property at all, many only have $75 in the bank, every property has at least 2 hotels on it, and free parking doesn't exist.
But the cost of living is outrageous in Canada.
How the hell is anyone existing in Canada? Like, I feel trapped. Can't afford the rent these days. Like,
I don't understand how I make $34 an hour and I can't function. I can't pay my bills.
Canada just ain't it. It's just like not it anymore. Like the cost of living, the wages are staying the same. $60K a year, that used to be like a decent amount of money. Not anymore.
how is everyone else, and are you okay? Because the answer is probably no.
Now, this is a complicated issue. However, I do have opinions, like everybody else, on why I think is happening. I kind of feel the housing market is a lot like the stock market, in that really no one can ever know truly what is going to happen, as there's so many external factors influencing the economy and this situation. And if they claim they know for sure what the housing market is going to do, they're probably trying to sell you something like a course.
Knowledge.
I don't think our primary focus should be on how it happened, who's the cause of it, who's to blame. But I think that we're in this situation now, everybody should kind of work together and try to figure something out. What I think would be great is to have all levels of government, especially localized government, business developers, maybe bank representatives, all sit down in one room together and talk about this. If we get all these great minds together, talking and trying to come up with a viable solution to this problem, hopefully Canada can work its way out of this housing crisis.
But it's going to require that everybody work together.
We got to get people in a room and have a conversation. There was way more that we agreed on than disagreed on.
The only way we are going to solve this challenge is with the federal government, the provincial government, and municipal governments working together.
I just feel, probably like everybody else feels, I just want a solution to be found. I really don't care who started it. I just want to get out of it. I just want to get out of this housing crisis and not have this hanging over people's heads any longer than it has to be. Of course, that's easier said than done.
Talk about all those, multiple layers of government and all of the groups that need to be involved. I imagine just getting everybody together in the same room would be a challenge and would take a lot of time.
Canadians are stuck in the middle of a very complicated housing storm, facing impossible home prices, severe housing and rental supply shortages, and interest rates that could potentially go even higher. Some people are predicting that this bubble is not only going to pop, but maybe burst wide open. Many people are riding the mortgage and rent roller coasters, just trying to stay afloat, experiencing sharp payment increases. Every month, many are going further into debt on credit cards and lines of credit just to keep the lights on and barely keep their heads above water. Some, thankfully, are able to make their minimum payments but are using a revolving cycle of debt to do it. This allows them to keep up with their monthly payments each and every month without having to sell their home at a loss and potentially tumble into even more debt.
In terms of what drives a lot of that borrowing, it's simply mortgages. 75% of the amount of money that we borrow is to finance your home or maybe a secondary property, an investment property, all of that type of ownership.
Others are searching online postings every day, waiting in lines to view rentals, struggling to scrape up enough money to escape a rental market that is going crazy due to supply and demand, feeling like finding a place that is remotely affordable is like winning the lottery.
But we've been so unreasonable, so unaffordable for so long that it is more realistic that people are trying to avoid spending half of their income on housing, and some are spending more than that just to be able to have a decent place to live.
You know how many people live here? Right now. Like,
yeah, it's a lot.
Is it cheap?
Cheap, but crammed.
I'll expand on some of the things that I mentioned in my previous video and other things I just didn't have time to say, as I wanted to keep the video to a decent length. Also, I'll touch on some of the great comments I received from all of you. The many, many great comments, actually. Thank you so much. I really, really do appreciate it. And thank you so much to all my newest subscribers. I'll also touch base on some of the lesser known things that many people aren't familiar with, things that do affect the Canadian housing market. Here are some interest rate predictions that I could see as being pretty accurate, as I think interest rates will hold for the short term, but then gradually begin to come down mid-2024. Again, my belief is that due to all this turbulence in the economy, waiting to see how the US economy fares, interest rates being where they are, homes being overvalued, inflation rates still unpredictable, along with many other factors, I think this is the worst time to buy a house. Plus, we have millions of baby boomers who will be retiring shortly, so that will increase demand in the workforce and hopefully have people transition into more affordable, smaller homes. Everyone is in the same housing storm, but everyone's situation is unique. Some people are in a home just trying to support a family, and yet the value of their home keeps decreasing, and yet the payments every year or month keep increasing. Other people are in an overpriced apartment experiencing severe rental increases. There's every situation under the sun here. People are also being impacted by lesser known but very important terms, such as trigger rate and negative amortization, and they are no joke. If that wasn't bad enough, well, Canada has just entered a recession. GDP growth remained relatively unchanged through July and August, and this trend is expected to have continued through September once those numbers are available. Of course, the government raises interest rates to combat inflation, but we have so many other external forces as well, some which we can't control. Other economies, the US and their interest rates and what they do, the price of oil and its supply and demand, so many other external factors that help influence our economy. Our government can only do, of course, so much. In this financial situation, unfortunately, there's going to be winners and losers. Many buyers are not wanting and so eager to transition out of their homes into a newer home because, well, they're getting less house for more money. Also, there are a whole bunch of costs that they have to factor and take into account. With these interest rates increasing, they're actually getting less house for more money. So they can continue paying their small mortgage in the house they already have, or if they transition out, the worry is they'll be paying more for a smaller home. Buyers are wanting sellers to move and transition out of their homes, so hopefully, one, they can escape this hellish rental market, and two, I'm sure some feel like they're just throwing money away, whereas that money could be going towards a house. Not to mention the steep rental increases that many renters are seeing.
I mean, I'm working 70 to 80 hour weeks, easy. And it's just like at the end of the month, there's like literally nothing left.
So renting in Toronto
it's literally like challenging people for Mortal Kombat. I'm not even being funny. Everybody's fighting for the few affordable houses that still exist.
A similar problem is actually happening in the US, where it's slowly turning into a buyer's market. Many sellers are wanting prices that they got, well, several months ago, or think that's the value their home should be worth. However, the market is not reflecting that. Mortgages and their relationship to bond yields. The interest rates on mortgages are closely tied to bond yields, particularly government bond yields.
Boring.
Mortgage rates usually rise alongside 10-year Treasury yields. When the yields on government bonds rise, banks often raise the interest rates they charge on mortgages. This, in turn, affects the affordability for home buyers. Governments also raise interest rates as a means to help control inflation. The BOC is always trying to keep inflation around the 2% mark. If inflation rises above 2%, the BOC may increase interest rates in an attempt to encourage borrowing and spending. Likewise, the opposite is true. If inflation falls below 2%, the BOC may decrease interest rates in an attempt to encourage borrowing and spending and help stimulate the economy. Here's an example. If government bond yields increase, a bank may increase the interest rate on a 30-year fixed mortgage from, say, 3 to 4%. This means higher monthly mortgage payments for borrowers, which can reduce the number of qualified buyers and impact housing demand. It's a hard problem to solve because the government is increasing bond yields, attempting to reduce inflation, balance the value of our Canadian dollar, assess whether quantitative easing is needed and how much, make housing more affordable, increase the housing supply, and maintain employment all at the same time. It's not easy, and there's only so much they can control. Right now, the government, while dealing and trying to manage all of these complex issues, is actually indirectly shaking the tree, seeing who is going to fall out. People in less financially stable positions will probably be the first ones to fall out of this tree. According to Bloomberg, 63% of Canadians are living paycheck to paycheck every month, and credit card debt is at an all-time high. There are, of course, many external factors that influence our economy that I touched on earlier. One of these is foreign investors. Foreign investors are more likely to pick a property in, say, Vancouver to invest rather than rural Saskatchewan, because they know they'll probably get a better return on their investment. There's only one direction, really, for new development in Vancouver to go, and that's to build outward away from the ocean, without, of course, tearing down older buildings. So real estate, especially oceanside, is a premium. Also, like I said, we are closely tied to the US, and they can influence our Canadian dollar. If people speculate and believe that home prices will increase and the Canadian dollar is weaker against, say, the American dollar, this will encourage more foreign investment. However, the opposite is true. If homes are predicted to drop in value, this would discourage foreign investment, especially if the Canadian dollar begins to strengthen in value, because a foreign currency would not stretch and buy as much if our Canadian dollar was weak. A predicted drop in house prices also discourages REIT investing, even from domestic investors. Many people next year are going to experience what is known as payment shock, as about 55% of mortgages are coming up for renewal in 2024 and 2025.
So that wave of resets, when those mortgages renew, ones that were taken out at rock bottom rates only to now have to renew at much higher rates, we'll see monthly payments just balloon, and it'll be quite a shock.
And this will strongly impact people who have not paid down their debt and are staying in their home, especially for static variable payment mortgages.
Realize that rates will not go back to those low levels, so don't hold out hope. Anyone who feels that they are in trouble should adjust and maybe make some moves now before they face that tough music that's coming ahead.
Canadians are more financially stressed than ever before, and I can see why. The average Canadian would need an annual income of $189,000 to be able to afford a home. Of course, this varies by region. 59% of people's net income is directly being applied to their mortgage as of Q2 2023. However, banks may approve people who can pay up to 35% of their net income. Of course, just because a person is approved for a larger mortgage doesn't mean they should take it. Obviously, I don't think it's a great idea to cross that 28% boundary, as there's so many other things you have to take into account other than just your mortgage, such as home insurance, property taxes, when making that determination. So let's talk about banks for a little bit. I think we should go back to the strict regulations and lending practices that Canadian banks were once known for, where this helped prevent people from becoming over-leveraged in their home, buying overpriced homes that they can no longer afford. Now, I don't like the idea of turning someone down for a home that they want, but I think it's a far better practice to turn them down and have them go into a smaller home that they can live comfortably and financially afford, rather than try to have them over-leveraged, getting them into a really large house where they have that financial burden hanging over their head each and every month to make their mortgage payment. I think this is a far better decision for them and the bank in the long run. One dismal factor for Canadians is what is known as recourse loans. For all mortgages in Canada, in all provinces besides Alberta and Saskatchewan, if your mortgage is classified as being a recourse loan, the lender can go after the borrower if the asset used as collateral does not pay off the debt owed. If you are forced to sell your home because you can't afford it, and you are unable to pay back the full mortgage taken out on that home, lenders can go after your personal assets until your mortgage is paid off in full. So a person not being able to afford the high interest payments on their home is forced to sell their house. When they sell, they will not only experience a decline in the home price, but they are struggling to repay the full amount of the difference between the original mortgage value taken out and the decline in the current value which they sold it at. If losing value and selling your home for less than you originally paid wasn't bad enough, you won't like this next part. Some homeowners are actually seeing their mortgage increase, not the house's value, but the mortgage itself. About 3/4 of variable rate mortgages have fixed payments. About 2/3 of a mortgage payment go towards the principal, and 1/3 the interest owed. When interest rates change and move, the mortgage doesn't change, but the portion applied to the principal and the portion applied to the interest owed does shift and adjust. If interest rates go down, a larger portion of the payment is applied towards the principal. However, if interest rates go up, a larger portion is applied towards the outstanding interest. Over time, a lender can experience what was originally 2/3 going towards principal and 1/3 going towards interest to having 60 to even 90% going solely towards just the interest payments on a mortgage. A final nail in the coffin is that mortgages can hit what is known as the trigger rate. The mortgage trigger rate is the interest rate when your mortgage payments only cover the interest, with none of the payment amount going towards the principal balance. The only type of mortgage that will ever hit its trigger rate is a variable rate mortgage. Fixed and adjustable rate mortgages will never hit their trigger rate. If you hit your trigger rate, it means your current mortgage payment isn't enough and you have 4 options available to you. You can increase your monthly payment, make a one-time payment on the principal amount. A lender might give you the option to switch to a fixed interest rate to prevent further interest rate hikes, or you can apply the unpaid interest back onto the principal, a negative amortization mortgage, which I mentioned earlier. The unpaid interest is added back onto the principal, which increases the amount owed on the total mortgage. That's why it's called a negative amortization, because usually the balance on your loan decreases as you make payments. However, in this case, your balance is actually increasing. This is where the 8th wonder of the world, compound interest, is actually working against you. The amount you owe keeps increasing on your mortgage as the payments you are currently making on your home aren't sufficient to cover the principal. This might seem impossible, but big banks have just disclosed that 20% of their mortgages are negative amortization mortgages. I also want to mention that as the baby boomer generation starts to retire, this will also have a dramatic impact on the Canadian housing market. This is expected to increase the number of homes for sale, and home prices could decline even further than they are now and will continue to do so for some time.
All of this is to serve as a reminder that people really need to take this very seriously. Cut back where they can. If they can't, then make some harder decisions to prepare for that big ballooning payment.
Now, this is a very complicated issue, and unfortunately, I can't get into everything, and I try to summarize it as best I can. I do want to go out on this note saying please donate to your local food bank, as I've just looked at some of the statistics and they're really troubling. 33% of people that use the food bank are children. 17% are working adults. These are adults with families and they have steady jobs and they're trying their best to make ends meet. And 8% are seniors, people who help build this country. So please, if you can afford it, donate to your local food bank because they sure need it.